It's been a very volatile month for stocks, for tech stocks in particular. Check out the NASDAQ. It's off more than 12% from its record close back in August. So we ask, is it finally time to step in here and buy the tech sector? Sean O'Hara of Pacer ETFs might have some answers for us. Sean, you like specific tech stocks here. Which ones?
Yeah, at Pacer, we have a fund that uses free cash flow yield as a way to screen broad indexes to identify stocks that we think have good long-term potential. And when you look at that screen, the part of the technology sector that pops out is not the soft, what we call the soft squishy side, the Facebooks of the world, the FANG kind of stocks, those big five, but it's really the backbone of the internet type stocks. It's hardware and software and chip makers that screen really well. And so we're overweight those types of names because we think there's a big long-term macro trend there that's going to continue. That's pretty robust. We're going to have build out in artificial intelligence. We're going to have build out in autonomous vehicles. We're going to have build out in e-commerce. You know, everybody thinks everything's sold by e-commerce is the dominant force today. It's only 15% of all retail sales, but it's expected to grow to 20%. So there's big growth there. And then the last one is streaming. And, you know, we all think about Netflix when we think about streaming, but everybody is getting into the streaming business to compete with them. So if you believe in those long-term trends, then what we would rather do is buy the backbone, the hard side of tech, as opposed to the soft, squishy side.
Yeah, it makes sense. And the stocks in particular are Microsoft, Micron, and what else did you recommend?
Broadcom and F5 Networks.
Okay.
You know, F5 Networks is an interesting name. You know, they're basically the security guard for people's networks on the in the technology side. So when you start to hear these big stories about Marriott's recent announcement, you know, we always find out afterwards about these data breaches. And those things are liabilities long-term for companies, either public image-wise or real liabilities. And so having the technology available to prevent those kind of things long-term is going to become more and more important. And that's really where F5 specializes.
We only have about a minute left, Sean, and I really wanted to talk about what the president said about General Motors. It's unusual to hear a president attack a company, maybe not unusual for this president. But listen to what he told Harris Faulkner yesterday.
All electric's not going to work. I don't run a car company, but all electric is not going to work. It's wonderful to have it as a percentage of your cars, but going into this model that she's doing, I think, is a mistake.
Is he right?
He's probably right. It isn't unusual for him to do things that other presidents have done, so that's a true statement. We wouldn't own GM based on one simple thing. They have got negative free cash flow, so they don't generate positive free cash flow. And I think longer term, GM has some other structural issues. The millennials are not car buyers, you know, they're ride sharers. And so the future demand for cars may go down. And so for those reasons, in addition to some others, like, you know, higher input costs, potentially wages rising, well, those are all potential negatives for a company like GM.
The president's saying all electric, that plan is a bad idea, but I'm not necessarily sure that's where General Motors is going. They want electric to be more of their path forward, in addition to the other things you mentioned. But, yeah, it's open for debate. GM stock getting hurt. Sean O'Hara, have a great weekend. Thank you.
Thanks so much, Lauren.